Generally speaking, I try to avoid falling in love with my stocks. What I mean by this is that if they become overpriced, I simply sell them. But there are some exceptions that I expect to hold forever, or at the very least for a very long time to come. These are real estate investment trusts that have exceptional business models that I expect to generate above average returns with below average risk, and unless something dramatic changes about them, I expect them historical performance to continue for many decades to come. These REITs own great assets, they have fortress balance sheets, shareholder-friendly management teams, exceptional track records of historical performance, and finally, even if their valuation becomes a bit pricey, this wouldn't necessarily be a big issue, as they would use this opportunity to issue more equity in the market, make additional investments at a positive spread, and this would only accelerate their growth prospects. I call these forever REITs, and here are 5 good examples of that. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about 5 of my favorite REITs to hold for the long run. Before I get started, I wanted to let you know that I plan to interview a few different REIT management teams over the coming weeks, and I will post some of that on my YouTube channel, so if you don't want to miss out on it, make sure to subscribe to the channel. The first REIT I'm going to discuss here is called Big Yellow Group, ticker symbol BYG. This is my favorite self-storage REIT, and I've held it since 2016 if I remember right. The pitch here is pretty simple. Over the past 30 years, self-storage was the most rewarding property sector. In the US, American self-storage REITs like Public Storage, Extra Space Storage, Life Storage, and so on managed to generate nearly 20% average annual total returns, far outpacing the returns of other property sectors, and that's despite also being the least volatile of all property sectors. These REITs were so rewarding because the concept of self-storage was rapidly growing in popularity, and these REITs were able to raise capital to build additional properties and earn exceptionally large spreads over the cost of capital. Typically, REITs like Realty Income are happy to earn a 100 to 200 basis point spread over the cost of capital when acquiring new properties, but these REITs like Public Storage were able to earn double or triple of that. But the problem is that the American self-storage market has now become very competitive. Everyone has witnessed these exceptional returns, and this has attracted a lot of new capital to the sector. New properties have been built all over the place, and therefore I expect future returns to be quite a bit lower than in the past. But the interesting thing here is that the European self-storage market is still 20 years behind, and Big Yellow is now replicating the same model in the UK. Currently, there's 10 times less storage space per capita in the UK than in the US, and Big Yellow is now building new facilities as the concept is growing in popularity. Today, Big Yellow has 11 new facilities under construction, which should expand its capacity by 15 to 20% in the coming years. And at the same time, its rents and occupancy rates also keep on growing, as it has a lot of new properties still in their lease-up phase. And all in all, this should result in rapid growth in the coming years. Historically, Big Yellow has been able to grow its FFO per share by about 10% annually. And if you add that to its near 5% dividend yield, you get to roughly 15% annual total returns, which is in line with its historic averages. That's far above average for REIT, and I find the risk reward to be exceptionally attractive here because it's coming from a fairly defensive REIT with low leverage and a defensive business model. The second REIT that I've already owned for many years and expect to hold for a long time to come is called VICI Properties, ticker symbol VICI. This is the leading casino REIT in the world. It owns many trophy assets like the Caesars Palace, the MGM Grand, the Venetian, and many other trophy assets on the Las Vegas Strip. What's very attractive about these property investments is that they are all under very strong long-term triple net leases. The average lease term is about 40 years. They include annual rent escalations of 2% or the CPI with some caps. The tenant is responsible for all property expenses, including even the maintenance of the property. They also have to reinvest millions into the properties each year according to the lease agreements. And finally, the properties are holding the licenses of the casino, and that gives them strong moats and barriers to entry. As a result, I expect the cash flow growth to be highly consistent in the future. Organically, the REIT should be able to grow its FFO per share by 3 to 4% just through its lease escalations, and then on top of that, the REIT is also retaining a lot of capital, and it's also issuing new equity and raising new debt to acquire additional properties at a positive spread. Historically, this has led to another 3 to 4% of growth, resulting in a 6 to 8% growth in FFO per share annually. Going forward, this is probably going to slow down a bit because the REIT is now a lot larger than it used to be. However, I would still expect it to grow by 5 to 6% per year over the long run. And given that the REIT is today offering a 6% dividend yield, I think it's very likely that investors will keep earning double-digit total returns over the long run as you combine the yield and the growth. And that's very attractive coming from a REIT that's so predictable. As a reminder, again, it has 40-year-long leases and it owns trophy assets. Hey, before I go into the next REIT, could you please do me a huge favor and click the like button? That helps me a lot to grow this channel. Thank you so much in advance. The third REIT I expect to hold for a long time to come is called Alexandria Real Estate, ticker symbol ARE. This is the leading REIT that specializes in life science buildings, which are properties that are used to research and develop new drugs. I like these properties because of several reasons. First of all, they enjoy secular tailwinds as the population is growing rapidly and more money is being pumped into research and development. Secondly, your tenant is typically highly dependent on your property because they also safeguard very valuable equipment and all of their intellectual property. Thirdly, these properties enjoy significant barriers to entry because they typically require highly specialized skills, relationships, and even licenses in some cases. Fourth, the leases are very long. The tenant is typically responsible for all property expenses, including the maintenance, and the rent escalations are also above average at 3% in the case of Alexandria. And then finally, this is a recession-resistant sector and lease defaults are extremely rare. Alexandria has now been investing in this sector for decades and it has an exceptional track record, having even outperformed companies like Walmart or Warren Buffett's Berkshire Hathaway. Today, its leases are 8 years long, they include 3% annual escalations, and its current lease rates also deeply below market because the market rents have grown faster than its lease escalations in the recent years, and as a result, as its leases now gradually expire, it's able to bump up rents quite significantly. In the last years, it's been able to bump up expiring leases by 15 to 20% in most cases. I like this a lot because it essentially provides a bank of future growth that has already secured, and on the other hand also, if market rates were to decline because of oversupply, we have good margin of safety here. Then on top of that, the REIT also retains about 40% of its cash flow to develop new properties, and it's also constantly recycling capital by selling non-core assets at cap rates of around 5.5%, and then redeploying these proceeds into higher yielding development projects. A final thing that I want to mention about Alexandria is that it has one of the strongest balance sheets in the entire REIT sector, with 13-year average debt maturities, a low 25% LTV, and BBB+ investment grade rating. Last year, they grew the FFO per share by 7%. This year, they are guiding to grow it by another 6%. And when you combine that with its 4.5% dividend yield, you should get to double-digit total returns in 2024 again. And that's more or less what I expect also beyond that. Again, that may not be the highest return that you could earn in the REIT sector, but I think that's very attractive coming from such a defensive REIT. The fourth REIT I expect to hold pretty much forever is called Essential Properties Realty Trust, ticker symbol EPRT. This is, in my opinion, the best net lease REIT. Ever since it has gone public, it has massively outperformed its peers like Realty Income, NNN REIT, WP Carey, and others. This is simply because it has a unique business model that allows it to grow its cash flow at a faster pace than its peer group. Last year, it grew its FFO per share by 8%, which was the highest growth rate in its peer group. And this year again, while growth is slowing down a bit, I expect it to beat most of its peers. This is because of 4 key reasons. Firstly, it's much smaller than most of its peers, and as a result, each new acquisition has a bigger impact on its bottom line. Secondly, it has one of the least debt in its peer group, which limits the impact of rising interest rates. Thirdly, all of its leases have above average rent escalations, and these also true triple net leases, which means that the tenant is truly responsible for all property expenses, including the maintenance. In some cases, some of its peers will also own a mixture of triple net and double net leases, and with double net leases, typically the landlord still has some responsibilities for the structure, the roof, and the parking lot. And the fourth reason is that Essential Properties Realty Trust is able to earn larger spreads over its cost of capital when acquiring new properties because it's focusing on smaller properties that are leased to middle market tenants. Today, the REIT is priced at roughly 13.5 times FFO, which is in line with its peer group despite growing at a faster pace. Again, here the expected future returns are pretty simple to calculate. You're getting a roughly 5% dividend yield, and the REIT should be able to grow at a 5 to 7% growth rate over the long run. This should get you to double-digit total returns, which is very attractive coming from such a predictable business model. And then the fifth and final REIT is my favorite cell tower REIT. It's called Crown Castle, ticker symbol CCI. Today the REIT is out of favor because going through some temporary headwinds, but over the long run it has done exceptionally well for its shareholders. It has massively outperformed the rest of the REIT market as well as the broader stock market as a whole. I like its pure American tower as well, but not quite as much because it's more spread out geographically. It's been investing all over the place in Europe, in Africa and elsewhere. I prefer Crown Castle's approach to only focus on the United States. That's because cell towers enjoy much greater barriers to entry in the US than in other markets, and therefore the quality of its cash flow should be quite a bit higher. Even then, the company is today priced at a historically low valuation of just around 12 to 13 times FFO, and it's offering a dividend yield in excess of 6%. That's exceptionally low for Crown Castle because typically it has been traded at closer to 25 times FFO. At its peak, it was even at over 30 times FFO, and typically its dividend yield has been closer to 3%. I think that what has happened here is that the market has overreacted to two things. The first one is the surge in interest rates. Sure, it has an impact on Crown Castle in the near term, but the company has a strong balance sheet, it has a BBB+ rating, it has relatively little debt, and therefore the rise in interest expense is very manageable. And the second and bigger issue is that there is no growth in the near term because the company is impacted by lease cancellations that are caused by T-Mobile's recent acquisition of Sprint. And so it appears that the market is today perceiving Crown Castle as a REIT with no future growth prospects, and as a result it's pricing it at a much lower valuation now, especially following the surge in interest rates. But if you actually look past the impact of these recent lease cancellations and the surge in interest expense, the REIT should be able to return to its historic growth rate of 7 to 8% per year. And when you combine a 6% plus dividend yield with a 7 to an 8% growth rate, you get to very strong double-digit total returns, which once more is very attractive coming from a BBB+ investment grade rated REIT. Final thing that I will add here is that there are a number of different activist investors today who are heavily investing in Crown Castle because they think that it's undervalued, and they are fighting over what's the best path to unlocking this value. This is causing a bit of uncertainty in the near term because Crown Castle is going through a strategic review. It's considering selling some assets. If they do, this could lead to a dividend reduction in the near term, but overall I view this as a net positive and as a catalyst to help the stock surge to a higher valuation. In my opinion, most REITs are not meant to be owned forever. At High Yield Landlord, which is my REIT newsletter, we'll typically look for REITs that are undergoing some temporary issues, which then allow us to buy our positions at discounted valuations, and then as the REIT work out their issues, they resolve problems, their valuations recover, and we end up making a gain as we exit our position a few years down the line. But some REITs are exceptions in that they have exceptional business models that should allow them to earn above average returns with below average risks, and those REITs I expect to hold for the long run. These 5 REITs are good examples of that, but there are many more, and if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. And otherwise, once more, could you please do me a huge favor and click the like button? That really helps me a lot to grow this channel. And if you don't want to miss our coming REIT CEO interviews, make sure to subscribe to the channel. Thank you very much, and see you on my next one. Bye bye.